All right, we're back with Tarish Bratra, VP of Investments at Range. Tarish, this has been a wild week. We have tariffs, we have market volatility. What's going on right now?
Yeah, it's hard to keep up. The news flow is nonstop. And I think people forget what it was like during the first Trump presidency. There's just headline news all the time. And news viewership and interest spiked massively during the first term, and it's happening again. And so for traders that want to react, there's a lot to react to. Whether they're human traders or algorithmic traders, there's plenty of news to trade around. And it's not totally surprising, generally speaking, that we're seeing a lot of volatility with Donald Trump in the news all day, every day, making headlines.
I think most people look at this and it's getting a little scary, right? We're seeing some numbers that we haven't seen over the last few years. So give us your take on that.
What we're seeing right now is uncertainty. And we've talked about this before, but investors really don't like uncertainty. And so I don't think right now it's driven by the impact of tariffs, right? So we don't know the impact of tariffs. We don't know how long they're going to last. We don't know what ultimate deals are going to look like. We don't know how manufacturers are going to respond, either here or internationally. And we've seen that policies and threats can change on a dime. So we don't actually know what the impact of tariffs is going to be, but it's a lot of uncertainty around tariffs and potential impacts. So I think right now, more than anything, there's a tremendous amount of uncertainty, and investors don't like that. And until people know the playing field better, they would rather be risk off, and many investors would rather wait and see.
So here we are, early March. Market's down for the year. S&P 500 is down. Magnificent 7 is really down. A lot of investors have a lot of money in those asset classes. What should investors think about as they zoom out a little bit, maybe for the next 6 to 12 months?
Yeah, I think, look, short term, it's always very difficult to call what's going to happen to the markets, and that's certainly not the game that we play. I think looking out more toward the medium term, the markets are incrementally concerned about growth, which makes sense, given that it's not as strong as it was. But we think fundamentally, the US is still in a very strong position. People have jobs, the labor market is tight, corporate and consumer balance sheets are still strong. There's secular forces around AI that are very powerful. Corporate earnings are still growing. So near term, we think that growth may slow because there's corporate and consumer uncertainty, which could also lead to increased short-term volatility in the markets. I think that investors should be prepared for that. In addition, we know that monetary policy has been restrictive, right? So we've talked about the fact that the Fed is trying to cool the economy. And so the restrictive rates that we've seen for the last couple of years, they're still permeating through the system. So it's not surprising that growth could slow. Medium term, we think if growth slows too much, we take a lot of comfort in the fact that the Fed has a lot of room to help and start stimulating the economy. So right now, already in a matter of weeks, the market is now pricing in multiple rate cuts. And a month ago, that had changed to one rate cut for the year. So the markets are starting to anticipate that the Fed may need to help the economy at some point this year. And whether they do or they don't, we don't know. But we do know that they have a tremendous amount of capacity to do that. So the punchline is be prepared for volatility, but we still feel very comfortable staying invested. We still have the US as a meaningful portion of our portfolios. And we think if you think medium term, if you think long term, you're going to be rewarded for that.
Fixed income is outperforming equity for the year. We haven't seen that in a while. Give us your thoughts on that.
Generally speaking, bonds are less volatile than stocks. In times when the equity markets are experiencing pressure and volatility, bonds can offer protection and hold up better. That's what they're supposed to do. Right now, the focus of the market has turned from inflation fears to growth fears. And investors are starting to get incrementally nervous about growth. You saw jobless claims move higher. You saw consumer spending have a weaker print. You're seeing consumer confidence fall, corporate confidence fall a bit. And so when you get nervous about growth, you start to anticipate that the Fed may have to cut at some point to stimulate the economy. So you start betting that rates are going to be lower in the future than they are today. And so when rates come down, bond prices move up. And that's what we're seeing right now. Bonds aren't up a lot, but they're acting the way that you would hope that they would act, as a hedge to your equity portfolio, and they're offering some protection. Beyond bonds, a diversified portfolio is doing what it's supposed to be doing right now and is also helping during this period of volatility. So European stocks are up in the teens already, and it's a couple of months into the year. Emerging markets are up 4 to 5%. So earnings expectations for these regions have actually been moving higher off of a low base If you have exposure to these regions, your portfolio is holding up a lot better than if you were just invested in the US. I think what you're seeing right now is that in periods of volatility, some diversification can certainly help. And if you do need protection in terms of your risk tolerance and how much money you can afford to lose near term if you're closer to retirement, then that fixed income portion of your portfolio is certainly helping right now weather the storm. I think short term, we can prepare to see a continued period of volatility. I think you can take advantage of that. So as an investor, this is your opportunity to harvest tax losses when the market draws down. Hopefully you have tax loss harvesting automated in the portfolio that you're in. It's a good time to rebalance portfolios. If you need to transition your portfolio into the right allocation, you can get more aggressive with those transitions today, given that there's opportunities to do it tax efficiently. It's also an opportunity to deploy capital. If you've gotten cash sitting on the sidelines and you're in the process of deploying capital, you're in the process of implementing a plan, you have a better entry point today than you did a couple of months ago. So I think there's opportunities constantly. I think, again, if you have a plan, then this period of volatility is already factored into that plan, and you're reducing the risk of you having to sell at the wrong time. And that's really what you want to avoid. You want to avoid making decisions that are emotional and reactive